Welcome back to Dukascopy TV. I'm joined in the studio by Catherine Reichlin, Portfolio Manager at Mirabaud, and we're talking the danger of low yields and curve distortions. Catherine, thank you very much for joining me today.
Thank you, Jennifer.
Now, firstly, what do people mean when they say that we're heading into uncharted waters? And what does this mean for fixed income markets?
In the last 50 years, the global economy went through 8 recessions, and quite usually central banks have restarted the economy by lowering interest rates. This last recession was different. It's the most sluggish recovery, yet the stimulus used by central banks are the biggest ever. So now in the US, since 4 years, the Fed fund haven't been moved. So we are in a zero interest rate policy environment. And on the top of that, central banks are using the most unconventional monetary policies ever. So what we see is that there are some curve distortion in the market, and that reading into curves is not possible like it was in the past. One example is with real rates, real interest rates. We have now low nominal rates, we have inflation expectation, and so this put together results in a negative real interest rates in the US, which wasn't the case since the 70s, so quite a long time, quite a long time. And last September, when the Federal Reserve decided to extend their quantitative programs, markets started to integrate some inflation. So you could see that through the break-even inflation that crossed the 2.5% mark. At the same time, the 10-year nominal yield was at 170, which seems too low. Last time we were at 2.5 with break-even inflation. Nominal yields were much higher. It was in May 11, 320 versus 170 now, so it's 1.5%, which is huge. 380 in 2010, and the 10-year was yielding at 4% in 2008. So what I'm saying is that nominal rates seem too low today compared with inflation expectations, and this is one of the curve distortion you can see in the fixed income market.
I see. And talking on curve distortions, what are causing these curves to lose their apparent predictive powers?
It's because they are manipulated by central banks. So several means to manipulate a yield curve. So there's quantitative easing programs. The Fed has extended its twist program. So the twist programs enables the Federal Reserve to sell short-dated bonds and buy longer-dated bonds. So this allows them to keep the longer end of the curve under a certain level, favoring households via mortgage rates. And another way to manipulate also the curve is the rhetoric. Federal Reserve started to say they would keep yields low for an extended period, and they time framed that period saying that it's going to be until mid-15. So as the 2-year bond can be used as a proxy for future Fed fund rates, if you know in 2012 that these rates won't be moved until 15, there is no reason the 2-year should move. So to summarize, I would say that the short end of the curve is manipulated by rhetorics and the longer end by politics.
And you were talking earlier about the central banks, but what will happen when the central banks abandon this unconventional methods that they're using?
Yes, that's a very good question. I think that's the big question at the moment, because there are going to be several risks to manage. Broadly, I see 4 risks. There might be way more, but let's go for 4 to start. First is short-term rates. So you know that when there's a movement on the short part of the curve, it impacts the longer end of the curve. Longer end is a second risk to manage, because once, yes, they will stop their policies. They may even revert these policies. So fixed income market will lose one of its best buyer, inflation, obviously. Yeah. I would even say inflation expectations, because this will be the turn. So we all know that central banks are better with managing inflation rather than deflation. And that being said, this inflation expectations will put pressure on the longer end of the curve. and to end up, I would say, risk aversion, because we are in an environment where there's a lot of risk aversion. So fixed income markets are benefiting from their status of safe haven. But once the perception change, you know, growth is back or you feel there's less risk, fixed income markets will also lose a support. So, yes.
Thank you, Catherine, for coming in and sharing your insights with us today.
Thank you, Jennifer.
That's all from us here in the Dukascopy studio, but just click back to the website for more interviews and updates. Take care.